ability to get financing down the road.
Mm-hmm.
One other thing that's always a challenge for small business owners is to make sure that you don't have permanent concentrations in business. From time to time, every small business will have a temporary concentration in business. But if you have that nice gravy account that is giving you lots of business and then it sneaks up to 75 or 80% of your total revenues, you're taking a risk that if that business went away, that could jeopardize the operation of your business. And I've seen it over the years where some small business owners have made that mistake of over-relying for an extended period of time on a concentrated level of business.
So when you say concentrated, what you're talking about is basically having one customer or maybe a few customers that really dominate your business. It's a little bit
Right.
like the supplier to Walmart. You
Right.
know, all of a sudden Walmart's everything, and then
Right.
and now they're against the wall because they're totally dependent on
Or you know, you have some big electronics company that's giving you favorable margins, and then next thing you know, the bulk of your revenues are coming from this one company, and you may feel that you have a very good rapport with the senior management of that company, and you're not worried. But then this company down the road gets into an economic difficulties and decides to outsource their work to overseas. And then overnight or they consolidate with some other company to
get acquired.
Yeah, and then next thing you know, 60, 70, 80% of your revenues drop off overnight,
Mm-hmm.
and then you're in trouble.
Yeah.
The reason why I keep saying profitability is really the key thing to work on is because that's really the source of repayment when you're looking at paying back a loan. After the business pays all of its expenses, what's left over is the profit, and that's what's available to pay back a loan. And so small business owners should always try to maintain at least profitable operations 2 out of every 3 years. So if you are in a tough situation and you have a bad year and you lose money, it's easy for bankers and CPAs and advisors and consultants to say, well, lay off somebody to lower your overhead to the lower level of your revenues. But sometimes you have to make those decisions after you've done everything else you can do, like cutting back hours and cutting back expenses, mm-hmm. to maintain that level of profitability. You know, if you're fortunate enough to always have positive earnings, it's important to keep some of that profit in your company so that you can keep that healthy balance sheet and then qualify for the bank loans and other and take advantage of opportunities in the good times and cover yourself when we're in challenging times.
Yeah.
And then the other point that is important is to also be careful on your overall personal financial position. When banks are underwriting a small business loan request, they're going to look at the financial condition of the owner or owners who have at least a 20% ownership interest in the business. So one of the mistakes that I've seen a lot of people make over the years is they'll set their standard of living, their personal lifestyle, at a point when everything is going wonderful and they're making very good profitability, and they trade in that $500,000 mortgage for a $1 million mortgage.
Ouch.
And then times get lean and the revenues drop, and then they have to cut expenses. But they still have to make that $10,000 monthly payment on their mortgage every month, which means they still have to take that higher level of salary out of their business, right, to cover their personal lifestyle.
Right.
So a good rule of thumb is to always try to maintain your personal debt-to-income ratio 50% of your gross income. So for example, if you're making $100,000 a year in income, you want to strive to not have your house payment and your personal credit payments to be more than $50,000 in that example. Mm-hmm. And try to, and if you do feel confident and you get that big $1 million mortgage, then set aside some liquidity in the good times to cover for the lean times. Because on average, 2 out of every 10 years, the economy goes into a recession, and periodically we go into a severe recession, and that can be the difference between keeping your house or maintaining your business in difficult times.
So also here I want to just interject. So when John's talking about liquidity, what he means basically is savings, cash, so that you have money to operate with, money to pay your bills and so forth.
Right.
And so anyway, now let's get into a little other area. What is the general thought process that a lender has when he's making or she is making business loans?
Well, the general thought process, for conventional lenders like banks and credit unions, is that they're going to look at what is the primary source of repayment for the loan? How do we get paid back? But they're also going to look at, well, if that primary source of repayment falls through, what's the backup source of repayment? What's the secondary source of repayment? So when a small business owner is going to the bank requesting a loan for their business, the banks are generally going to look for the loan to be secured by the assets of the company. That provides collateral as a secondary source of repayment. And they also will look for the personal guarantee of the owner or owners that generally have at least a 20% interest in the business. And again, that's to have that secondary source of repayment. Now, why do banks look for that secondary source of repayment? It's because they're operating in a low margin environment. Right now, if you go to a bank for a loan, most banks are going to have an interest rate of 5 or 6% on the loan, and they're going to pay 1 or 2% on the deposit. So they're working on a 4% spread. So if the bank is making someone a loan at 4%, let's say that loan's $100,000, the bank is actually making the loan with depositors' money, not investors' money. So if you were receiving a $100,000 loan from the bank right now at 6% and the bank was paying 2%, the bank would make $4,000 interest on that loan after a year. But the bank would have to put out $100,000 at risk to get that $4,000.
Right.
So because it's such a small margin in relation to the amount that's being loaned, the mindset is, what's that secondary source of repayment to help pay it back if the primary source falls through?
So in a sense what you're saying is the bank is sort of acting as a fiduciary. It's got its depositors whose money that they're lending.
Right.
And then,
Right.
of course, has to pay the depositors back, not to mention all the expenses that the bank has itself. Okay. Why would a business owner choose to work with a community bank instead of a large bank?
Well, it depends on the goals of the business and the needs of the owners, really. Community banks market themselves by providing a high level of service. And they also build their banks by relationship building. And so having some added value of a banker who, most community banks have bank officers who've been in banking for several years, 5, 10, 20 years. So you usually are dealing with someone who's experienced. A larger bank will also have people that have good experience, but they're structured a little bit differently. They're more of a transactional approach than a relationship approach. The bigger banks will generally have sales specialists who know exactly how to get the paperwork in to the central underwriting department. And then they will, big banks sometimes have an advantage in being able to be very interest rate competitive. If a big bank really wants to buy a loan, they can generally offer a lower interest rate than a community bank. Not always, but generally. So big banks can offer pricing. They'll have a little bit of competitive advantage on pricing. So if the price on a loan is important to a small business owner, if that's their main requirement, then they may